You spend hours building a perfect technical setup. The support lines are drawn, your indicators align perfectly, and the entry looks clean. You execute the trade, and instantly the price plunges straight through your floor. A surprise jobs report drops, or a central bank chair steps up to a microphone. In a split second, the rules of supply and demand are rewritten, invalidating your entire technical analysis. Add the rigid structure of traditional assets, like daily closing bells and massive weekend gaps that trigger slippage, and you are constantly fighting the clock to manage your exposure. Traditional markets leave technically skilled traders exposed to a barrage of external variables that no chart can predict. There is an alternative environment built specifically to isolate price action. They are called synthetic indices. It is a simulated market that operates 24 hours a day, 365 days a year, completely detached from the global economy. This diagram shows how that isolation works. Instead of tracking real-world supply and demand, the price movements are generated by a secure, auditable, random number generator. Keeping the system closed removes geopolitical noise, economic data releases, and sudden new shocks. What remains is a mathematically pure trading signal. Because these markets run entirely on logic, they are programmed to engineer distinct, predictable types of market volatility. Take a look at this graph. This represents a volatility index. The algorithm is instructed to produce smooth, continuous price movements. This creates stable, long-running trends that reward trend-following strategies. Now contrast that with a crash or boom index. Here, the behavior flips. You get a slow, steady progression of small ticks in one direction, interrupted by an engineered, sharp vertical drop. If we adjust the graph again, we see a range break index. The math forces the price to consolidate and bounce between two defined horizontal boundaries for an extended period, until it sharply breaks upward or downward. You no longer have to wait for the real-world market to produce the conditions you need. You simply open the specific index that matches the physics of your technical strategy. Without real-world chaos interfering, classic technical analysis tools can function with incredible precision. This chart displays a volatility index plotted with two moving averages, which simply track the average price over a set number of periods. Without erratic news spikes, when these lines cross each other, they provide a highly reliable confirmation of the trend's actual momentum. Now look at what happens when we apply an indicator to a crash index. The bottom panel shows the Relative Strength Index, or RSI, measuring the speed of price changes. When the engineered crash occurs on the main chart, the RSI line instantly strikes the lower boundary, pinpointing the exact mathematical oversold zone for a retracement trade. In a simulated environment, rules-based logic succeeds over emotion. The math plays out exactly as drawn. Precision does not mean safety. This algorithm moves with incredible speed. When you combine that relentless momentum with high broker leverage, you are stepping into a highly volatile and completely unforgiving environment. This visual breaks down the risk. Leverage allows a small initial deposit to control a massive position size. If you are heavily leveraged on a crash index, a single engineered drop of even a fraction of a percent against you instantly triggers a margin call and wipes out your entire margin. The algorithm is mathematically ruthless. Absolute, unwavering discipline in your risk management is your only line of defense. You must strictly adhere to the 1% risk rule, never risking more than 1% of your total account on a single setup. And you must calculate your exact position size before you ever open a trade. You also cannot afford to manage risk manually once the trade is live. Because the market operates so quickly, your stop-loss order must be set inside the trading platform before execution. Beyond the chart, there is a structural reality you have to account for. Synthetic indices are proprietary instruments. You aren't trading on a global, decentralized exchange. The broker itself acts as the direct counterpart to every single trade you make. Operating in a closed ecosystem requires an extensively regulated, highly transparent broker. That regulatory oversight guarantees the random number generator is fair and actively audited. This is where the FXNX One account becomes an essential tool. It provides a strictly regulated foundation built specifically to execute these advanced technical strategies. To survive in a high-speed sandbox, your platform has to keep up. FXNX equips you with 0.0 pip spreads and ultra-fast execution through MetaTrader 5, giving you the tightest possible control over your entries and exits. Leave the unpredictability of the news cycle behind. Open an FXNX demo account today and put your technical edge to the test.